Investment risk. What is investment risk? So, for the investors, investment risk refers to the degree of uncertainty and/or potential financial loss inherent in an investment decision. In other words, when you invest your money, you don't know for sure if you'll receive the desired returns or experience unexpected losses. But whereas your investment doesn't come just from stock market moves, the economy lean or of investment time and more, it'll pose potential risk to your investment. What is risk? So all investment involves some degree of risk, although most people think of risk only in terms of loss. Risk is the chance that an investment may decrease or increase in value from what is expected. Simply put, risk is a measure of how much an investment's actual return differs from what the investment is expected to return. Riskier investments comes with the potential to earn higher returns, while less risky investments generally have lower returns. What is investment? So an investment is essentially an asset that is created with the intention of allowing money to grow. The wealth created can be used to a variety of objectives such as meeting shortages in income, saving up for retirement, or fulfilling certain specific obligations such as repayment of loans, payment of tuition fees, or purchase of other assets.
Types of investment risk. Inflation risk. It is the tendency for prices to increase over time. Its effect on investment is that future dollars, which are your investments, will not have as much buying power. Next is the longevity risk. It is the risk of outliving your savings. Its effect on investment is that the length of retirement is undetermined, making it tough to know how much money you'll need. Next is the market risk. It is the risk of loss due to financial market performance. Its effect on investment is that stocks vary from day to day and year to year, which can have a negative effect on investments. Interest rate risk. It is the risk to savings and loan rates if interest rates change. Its effect on investment is that for money you want to grow or investments, interest rate increases are generally positive. One is the credit risk or corporate bonds. It is the risk of default by the issuer of the bond. Its effect on investment is that bondholders may not be paid the promised interest or the full principal.
There are 9 types of investment risks you may be exposed to as an investor. Number 1. Market risk. The risk that your investment may decrease in value due to economic development or event that affects the entire market. And there are 4 types of market risk. The first one is equity risk. The risk that share prices in general will fluctuate. Second is interest rate risk. The risk that interest rates will fluctuate and impact the value of that investment, like bonds. Third is currency risk. The risk that the exchange rate will fluctuate and impact the value of an investment in foreign currency. Fourth is commodity risk. The risk that commodity, crude oil, corn, etc. prices will change and impact the value of an investment. Liquidity risk. Liquidity refers to how easy it is to buy or sell an investment. Liquidity is the risk of not being able to sell your investment at a certain price when you want to. For example, some investment may require you to hold them for a certain length of time before you can sell. Concentration risk. The risk of loss when all your invested money is concentrated in one type of investment. Diversification can minimize this risk by owning different types of investment in different industries and locations. Credit risk, also referred to as a default risk. This applies to debt investments such as bonds. It is the risk that the government or company that issued the bond will be unable to pay the interest or repay the principal at maturity. The bond's credit rating can help you evaluate credit risk. Reinvestment risk. The risk of loss if you reinvest your investment returns as a lower interest rate. Inflation risk. The risk of loss in your purchasing power if your investment does not keep up with the inflation. Horizon risk. The risk that your investment timeline or horizon may change because of an unexpected life event. For example, the loss of a job may cause you to have to sell your investment earlier than you expected. longevity risk, the risk of outliving your savings or investment. Foreign investment risk, the risk of loss when you invest in foreign countries. This can include investing in equities in foreign companies or simply making an investment with an entity that is not based in Canada. There can be currency risk, political risk, or interest rate risk that might not affect similar investments within Canada.
3 strategies to help reduce investment risk. Strategy 1. Assess allocation. Appropriate asset allocation refers to the way you weight the investment in your portfolio to try to meet a specific objective. It's the act of investing in different asset classes such as stocks, bonds, and alternative investment, and cash. Asset allocation, for example, if your goal is to pursue growth and you're willing to take on market risks to reach that goal, you may decide to place as much as 30% of your assets in stock and little as 20% in bonds. Before you decide how to divide the asset classes in portfolio, make sure you never your investment time frame and possible risks and rewards of each asset class. Different asset classes offer varying levels of potential return and market risks. For example, unlike stock and corporate bonds, government bills offer guaranteed principal and interest. Although money market funds that invest in them do not, as with any security, past performance doesn't necessarily indicate future result, and asset allocation does not guarantee and provide. Strategy 2. Portfolio diversification. Asset allocation and portfolio diversification go hand in hand. Portfolio diversification is process of selecting a variety of investments within each asset class to help minimize investment risks. Diversification across asset classes may also help lessen the impact of major market swings on your portfolio. How portfolio diversification can reduce investment risks. If you were to invest in the stock of just one company, you will be taking of greater risks by relying solely on performance of that company to grow your investment. This is known as single security risk. The risk that your investment will fluctuate widely in value with the price of holding. But if you instead buy stock and 15 or 20 companies in several different industries, you can reduce the potential for a substantial loss. If the return on one investment is falling, the return of another may be rising, which may help offset the poor performer. Keep in mind this is ultimate risk, and there is no guarantee against investment loss. Strategy 3. Dollar cost averaging. Dollar cost averaging is a disciplined investment strategy that can help smooth out the effect of market fluctuation in your portfolio. With this approach, you apply a specific dollar amount toward the purchase of stock, bonds, or mutual funds on a regular basis. As a result, you purchase more shares when prices are low and favor for shares with price and high over time. The average cost of your shares will usually be lower than the average price of those shares. And because this strategy is systematic, it can help you avoid making emotional investment decisions, thus minimizing investment risks.
More basic investment tools and the risk they carry. Now let's move on to look at 4 types of asset classes to see which investment tools are more suitable for your risk appetite and financial goals. 1. Unit trust. A unit trust will involve your money being invested in a diversified portfolio alongside other investors by a professional fund manager. The risk level for unit trusts vary from fund to fund, but generally your capital or your exposure is spread over all of the different investments in the portfolio. Instead of just one, you also have the choice of investing across a number of sectors, themes such as healthcare or tech, or even specific country or region or group of countries region. Number 2. Foreign exchange or FX. FX investment essentially involve transactions in different currencies where your returns depend on exchange rate movements. It is the world's largest market, bringing enormous liquidity, with an average of well above $6 trillion being traded daily. 11 beautiful month. Exchange rates are impacted by constantly changing macroeconomic and global socio-political factors. Is the currency you're investing in pegged to another, like the US dollar, it could then be impacted by what happened in the country. So you'll have to monitor for the effects of elections, quantitative easing, and other events that happen there. Number 3. Securities. Securities are tradable financial investment, carry monetary value such as stocks, bonds, mutual funds, and exchange-traded funds, or ETFs. Generally, there are two types of securities, equities and debt, and hybrid securities that are a blend of both. Investing in securities bring with it market risk. Take a stock price that could move up and down, for instance. There are also business risks associated with the companies behind the securities. An announcement of a CEO stepping down might push share prices down, while a confirmed takeover by a reputable buyer may see price climbing. Bonds. Bonds are investments where you loan money to a corporate or governmental bond issuer, who then use capital raised from bond offerings to fund their operations or to purchase assets. Bonds are a type of debt instrument because issuers are obligated to pay back the amount you invested plus a certain extra percentage. Default risk and credit risk are always present with bonds. If the issuer of the bond doesn't default, then you'll receive the principal amount of the bond at maturity or during stipulated intervals. And if you pull the plug on your investment earlier than the bond maturity date, there is also a risk you'll lose some of your investment.